A bit of action on the markets overnight after Mr. Bernanke, Bernanke, Helicopter Ben, the chairman of the US Federal Reserve, had a bit of a chat and then a question and answer session, and also the FOMC minutes were released. The Japanese stock market down 7.3%, which is the worst performance since March 2011, and the biggest one-day reversal on the Dow Jones since November 2008. What's it all about? On the line now from London is Jane Foley from Rabobank, senior FX strategist at that institution. Jane, it made my heart sing last night, actually, because of the naivety of the market. The market was up hugely in the first couple of hours when Mr. Bernanke sat down, and everyone said, well, we're buying this for the reasons that we've known about for many, many months. And then he started to sort of dither a bit, and down we came. It was great fun.
Well, it just goes to show really how much the market has really rallied over the last few months. Now, clearly, over the last 6 months, there has been, if you like, some exuberance in the market. We've seen very, very strong gains, many equity indices hitting record highs. And in concert with that, we've also seen, say, non-investment grade credit, also the yields there hit new lows too. So there's this huge want to take on risk. And yet, if you look at the economic data, well, what have we got? We've got China slowing, we've got the Eurozone in recession, and the growth rate in the US is still relatively lackluster. So there is this difference between the economic data and what the equity indices and other risk indices have been doing. And that means that what the Fed said yesterday, he just pricked that bubble just a little bit. Market very sensitive, I would say, to the potential for some downside given the gains that we've seen. The Fed, or Bernanke at least, has opened the door perhaps to the possibility that we might see the Fed slowing down those taps of liquidity perhaps as early as June. And as we saw some significant consequences to that.
Quite right. Psychologically, very, very important. It doesn't really matter whether they bring it back from 80, 85 billion, whatever it is, to 50 billion. The fact is that psychologically we've been used to an expansive policy from the US Federal Reserve. And what happened last night, I think, really does tell us the nature of the market. Because if the market was going up for good, solid, fundamental reasons, it wouldn't have come down like it did last night. So there is a lot of froth in the market. And I just wonder if, as I said to my previous guest, if this is different this time, at least in the short to medium term.
Well, it really very much depends on the Fed and the other central banks and the timing at which they decide to turn down that liquidity taps. It's going to be a massive issue for the markets over, say, the next 5 years or so. Now, the central banks will be aware of the difference between what economic data are saying and the demand for risk in the market over the last few months, and they will be aware that anything that they do to turn down those liquidity taps could risk creating market volatility, which would not be what they want. So it's going to be clearly very, very important. But the other thing to say is that most investors in the market are also very much aware of the fact that economic data is not that great, and yet there has been this push into risky assets. Investors are aware of that, and yet they've been buying the risk anyway because they don't want to underperform their indices or their measurements or their benchmarks. So the important thing is here, I think, for central banks, once they do start to normalize their policies, not to allow markets to crash too hard. And I think the important thing to remember also is that for most central banks, we're very much still on a path where even more accommodation could come through. The Fed might be considering slowing down the tap, but certainly for central banks such as the Bank of England, maybe the Bank of Japan, maybe the ECB, maybe the RBA, further easing is much more possible over the next few months than not, or than a tightening. So from that point of view, I think risk appetite should still find decent support.
There's been a lot of noise around, and I wonder how Mr. Bernanke feels about certain of his colleagues going on various different media and talking about this, because this and that. And one person will say, well, yeah, we're going to taper off quite soon. The other person says something different. And then Ben Bernanke a couple of months ago came in and squashed that. But there is a lot of noise around. And I think when markets are uncertain as to what the clear policy is, especially after last night's Q&A, then we've got some trouble, especially at the elevated levels. The Fed really must be very careful, I think, about how they manage the situation.
I think that's exactly right. To be honest, the biggest example of this was back in 1999 after the euro was launched, and so many policy officials were saying so many different things that it was undermining the very existence, really, or the very perceptions of what the euro was. And as a consequence to that, there really has been a policy within Europe as a whole to say very little about the euro itself. You very rarely hear Draghi really mention the euro, or other officials too. And I think the Fed will be aware of that. They'll be aware that, for instance, that the market was very sensitive to the comments from the hawk Plosser last week. But Plosser, of course, is not a voting member, and yet the market reacted very significantly. So perhaps over the next few weeks and the next few months, Bernanke may try and rein in some of that talk, particularly, of course, if it does get close to the forthcoming FOMC meetings. You generally see less comments in the immediate vicinity of those meetings, but it could be problematic. But others would argue, well, you know, it's free speech. The market really does need to know what these various members of the FOMC are thinking, because it helps investors put on their positions ahead of these meetings.
We are, of course, guilty in the media. I'm one of those people of over-analysing things, but it's nice to have a good story to get your teeth into. I'm just looking back to the irrational exuberance phrase from Alan Greenspan. It's a phrase, I'm just reading from Wikipedia here, it says it's a phrase used by the then Fed chairman Alan Greenspan in a speech given at the American Enterprise Institute during the dot-com bubble of the 1990s. The phrase was interpreted as a warning that the market might be somewhat overvalued. Did we have an irrational exuberance moment last night, Jane, when he talked about the stock market being a roller coaster? Because to me, that was a shot across the bows.
Well, maybe it was, but to be honest, I would say it's very difficult to argue with those underlying sentiments. And I think most investors are very much aware of that discrepancy, really, between those huge rallies that we've seen in many risk indices and what economic data are saying. For instance, if you look over the last 6 months, the big forecasters, such as the IMF, such as the OECD, they've tended to revise lower their forecast for world growth, and yet over the same time frame, you've seen risk indices push higher. So most investors are aware of this, and therefore it's very difficult to argue that there is complete rationality between the push into risk appetite. But at the end of the day, as long as the Federal Reserve, Bank of Japan and others are producing or allowing us this cheap liquidity into the markets, then the behavior of investors is going to be to move into more riskier assets. So this is a situation, if you like, of the central bank's creation. You could say that it was necessary after the financial crisis to restore confidence. Has it gone too far? Perhaps it has, but whether or not we're going to have asset price bubbles, I think is probably not necessarily a question for this year, but certainly for the next 2 or 3 years. And this is the time frame in which the withdrawal from this very accommodative policy position is going to be extremely important for central banks and for markets, because the central banks have got to be very, very careful as to how to do that. And yesterday's very sharp drop in stock market indices is just a taster as to why they do have to be so careful when they do decide to withdraw that liquidity.
Quite right. We've been talking about equity markets, which is unfair because your particular expertise is foreign exchange. How does this change the euro-dollar game, the dollar-yen game? Well, we've got our own problems in South Africa with the rand on a fearful trot to the downside at the moment. But euro-dollar, first of all, what does it mean?
Well, Eurodollar, I mean, and clearly it very much depends on the pace of the dollar. What the Fed has done is promote the value of the dollar by suggesting that perhaps there's going to be less policy accommodation. That's dollar supportive. But I would also say that by producing still a lot of liquidity in the market, by the Bank of Japan doing something similar, by the ECB producing a very accommodative policy, there will still be demand for risk appetites. And I think that will mean that any movement back into the US dollar will be quite moderate, will certainly be very measured. Now, if we go back to euro-dollar, we've been very concerned over the last few years about the crisis in the Eurozone. That has stabilised. It's certainly not gone away, but it has stabilised this year. But it's not all bad news in the Eurozone, despite the fact that there is recession. There is a strong current account surplus, for instance, in the euro area. There are improvements on the trade positions of some of the peripheral countries such as Spain, such as Portugal, that there is a more confident outlook in the very coherence of EMU relative to last year, and that is supportive of the euro. So I think that any downside in euro dollar could be limited. I think we could hit the 128 level, say in the 3-month view, but I'm not convinced that we're going to carry on a downside path for euro dollar. I think instead, near term in the next 2-3 months, we could be between 128, 130-ish. And further out, it could be that the euro again wins the game, and we do see euro dollar rising above 130, perhaps to 134 at the end of the year.